You can feel it again, can't you? Not just in the price, in the behavior. The comment sections are louder, the screenshots are back, people are posting receipts like it's a sport. Dealers are getting flooded with the same two questions. Do you have it? And how long will it take? And every time silver throws one of these violent candles up, down doesn't matter, another wave of people shows up with the same belief. This is it. The retail wave is here. Silver's finally going to do the thing. And here's the truth. I don't think the retail wave is done. But I also don't think this is a one-way trade. Because silver is the kind of market that can reward you with a surge and punish you with a gut punch in the same week. So today I'm going to do this in plain English. No hype. Why the retail wave still has fuel. What makes this volatility so dangerous and how it can cut both ways. So you don't get emotionally tricked into making the exact move. Silver is built to punish. Quick check-in before we start. Comment one word, stack or trade. If you mostly buy physical and hold, write stack. If you're mostly in paper products and timing moves, write trade. One word, then we move. Okay, let's start with the simplest idea that explains everything you're seeing. Silver lives in two different worlds, and those worlds don't always move in sync. There's the physical world, coins, bars, inventory, fabrication, shipping, premiums, delivery time, real objects, real constraints. And there's the paper world, futures, options, leverage, ETFs, exposure, contracts that can expand and contract fast. Most people only watch the screen price and assume it represents the silver market. It doesn't. It represents a price that is heavily influenced by paper flows in the short term, even when physical demand is doing something completely different underneath. That's why you can get a day where spot drops hard and your dealer still doesn't feel cheaper. That's why you can get a day where spot pumps and retail gets cleaned out even though the vault numbers look fine. Two worlds, and the retail wave mostly lives in the physical world until it spills into paper and turns volatility into a monster. Now when I say the retail wave isn't done, I'm not saying silver is guaranteed to moon. I'm saying the ingredients that create repeated retail surges are still present. Retail waves don't run on spreadsheets. They run on human behavior. And the behavior tends to follow the same loop. A big move happens. The story spreads. People feel late. They buy to relieve that feeling. Availability tightens. Premiums widen. That tightening becomes more story. More people buy. It's self-feeding. And silver is one of the easiest markets for this to happen in. Because it sits at a weird intersection. It's a monetary metal when people get nervous. It's an industrial input when the world is building. And it's small enough, thin enough, that emotion can shove it around faster than people expect. That combination makes silver uniquely capable of going viral as an asset. Now here's what keeps the retail wave alive even after it should be over. First, distrust. When people feel like systems are unstable, financial systems, political systems, supply chains, whatever, some people don't want another promise. They want something tangible. Silver fits that psychological slot because it's accessible compared to gold, and it feels like real money to people who are wired that way. Second, affordability psychology. Even when the percentage move is the same, a cheaper unit price feels easier to buy. A lot of retail buyers don't think in portfolio math. They think in units. I can buy a tube. I can buy a bar. I can buy a few ounces. That matters. It keeps waves alive. Third, the shortage story. Whether it's true or exaggerated, the feeling of it might not be available later is rocket fuel for retail demand. People don't buy faster when they're confident. They buy faster when they're uncertain. Fourth, community momentum. Retail waves are social. People buy because other people are buying. They watch videos. They share receipts. They feel like they're part of something. That's not an insult. That's how humans work. So yes, the retail wave can keep going. It can come in pulses. It can retreat and return. But now we get to the part most people ignore until they get cut. Volatility. Silver volatility isn't just price movement. It's a weapon. It cuts both ways. And if you don't respect it, it will turn you into an emotional hostage. Here's why silver volatility is so dangerous. Because silver is one of the easiest markets to whip around with leverage. And leverage doesn't just amplify gains. It amplifies forced behavior. This is the piece that separates people who survive from people who become liquidity. In a leveraged market, the rules can change mid-game. When volatility spikes, margin requirements can rise. When margin requirements rise, people who can't post more collateral are forced to reduce. Forced selling creates bigger drops. Bigger drops create more volatility. More volatility creates tighter collateral demands. And suddenly you're watching a feedback loop, not a normal market. Drop, volatility, margin, forced selling, liquidity thins, bigger drop. That's the crash engine. Now here's where it gets interesting for this title. Retail waves and volatility can coexist. Retail can be buying physical steadily while paper markets are whipping the screen price around. That means you can get a world where retail is strong, physical premiums stay firm, availability tightens, but spot price still swings violently because paper flows are dominating the short-term quote. That's what people mean when they say paper and physical disconnect. It's not magic, it's structure. Now, how does volatility cut both ways? Let's make it concrete. Way 1, it cuts. It creates upside squeezes. If enough participants are short or positioned wrong, a sharp upside move can force covering. It's not about morality, it's about survival. People buy because they have to. That forced buying can turn a normal rally into a face-ripping spike. Way 2, it cuts. It creates downside flushes. If too many participants are long with leverage, a sharp down move triggers liquidations, forced selling, and air pockets. That's when you see silver fall like it got dropped. Not because the world stopped using silver, but because the paper market is clearing weak hands. Silver can squeeze you up and liquidate you down. Same market, same week. That's why I keep saying it cuts both ways. Now I want to challenge the biggest retail trap in silver, because it's the one that ruins people. They assume retail wave =, price must go up in a straight line. No, retail waves are not straight lines, they are pulses. And silver is famous for doing this thing where it punishes both greed and fear. It spikes to make you chase, then it dumps to make you regret, then it grinds to make you bored, then it spikes again. It rotates emotions like a machine. So the question you should be asking is not, is the retail wave done? The better question is, are you positioned in a way that can survive the volatility while the wave plays out? Because the retail wave can be right, and you can still get hurt badly if your positioning is fragile. Now let's make this practical. What should you watch next to understand whether the retail wave has fuel and whether volatility is about to cut you? Here's the measurable watch list, simple and specific. First, retail premiums and availability. If retail premiums stay firm or rise during dips, and delivery times stretch, that tells you physical demand is resilient. That's wave fuel. If premiums soften quickly and availability improves, wave pressure may be cooling. Second, dip behavior and spot. Do dips get bought quickly, or do they keep falling and rebounds fail within hours? Strong waves buy dips, weak waves don't. Third, volatility direction. Is volatility rising as price falls? That's stress building and liquidation risk rising. Is volatility peaking and compressing while price stabilizes? That can signal forced selling is exhausting. Fourth, liquidity fingerprints. Look for air pockets, fast drops, big candles, wide spreads, ugly gaps. Repeated air pockets means thin liquidity and a higher chance of cascade moves. Fifth, leverage tightening signals. If brokers and platforms start tightening leverage or raising requirements, that increases the risk of forced selling in paper markets. That's when the same chart move becomes more dangerous. Now I'm going to split the advice by who you are, because silver destroys people who mix these worlds. If you're a stacker physical holder, your job is to not let the screen price become your emotional boss. Physical buying is a long game. Premiums and availability matter more than intraday candles. If you're stacking and you're refreshing the chart like it's a heartbeat monitor, you're doing it wrong. If you're a trader paper products, your job is survivability. Because silver is not a gentle market. It can move against you fast enough to erase weeks of progress in an afternoon. So your edge isn't being right. Your edge is not being forced. The market doesn't have to beat your thesis. It only has to beat your margin. And if you're using leverage in silver, understand what you've signed up for. You're trading a market that can change the rules when volatility spikes. Now for everyone watching, stacker or trader, here's the one rule that survives both up squeezes and down flushes. Don't let your position size turn you into an emotional hostage. If a move ruins your sleep, you're oversized. Reduce it. You'll think clearer, you'll act better, and you'll stop becoming liquidity for people who are more patient than you. Now one comment prompt, and I'm keeping it to one. If you had to choose what hits next, squeeze or flush, one word, squeeze or flush. And here's the final takeaway, one sentence. The retail wave isn't done, but silver volatility doesn't care which team you're on, and it can reward you or cut you depending on how fragile your positioning is. If this helped you, subscribe. I'm going to keep breaking down silver in plain English without the hype, because silver punishes people who trade slogans instead of structure. And send this to one person who thinks volatility is just noise. Not to dunk on them, to save them from becoming the next forced seller. Educational only, not financial advice. I don't know your situation. Nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and don't let a candle make you do something stupid.